In today's video, we're diving into a crucial topic that affects us all, the detrimental effects of excessive money printing on the economy. While it might seem like a quick fix to financial woes, printing more money can lead to inflation, eroding purchasing power, and destabilizing markets. This oversupply of currency can create a vicious cycle of rising prices, making everyday goods and services increasingly unaffordable. Understanding these economic principles is vital for making informed decisions about fiscal policies and personal finances. Join us as we explore the intricate relationship between money supply and economic health, and why it's essential to grasp these concepts for a stable financial future. Inflation and its consequences. When a government prints more money, it increases the money supply, which often leads to rising prices, a phenomenon known as inflation. As more currency circulates, the value of each dollar diminishes, meaning consumers can buy less with the same amount of money. For instance, during the hyperinflation in Zimbabwe in the late 2000s, prices skyrocketed and basic goods became unaffordable for many. Similarly, Germany's Weimar Republic experienced extreme inflation in the 1920s, where people needed wheelbarrows full of cash just to buy bread. These historical examples highlight how unchecked money printing can erode purchasing power, making it crucial for us to understand the implications of inflation on our daily lives. Devaluation of currency. Currency devaluation occurs when a country's currency loses value relative to other currencies, often due to excessive money printing. This devaluation can have significant implications for the economy, including increased costs for imports and a potential rise in inflation. A weaker currency makes foreign goods more expensive, which can hurt consumers and businesses reliant on imported products. For example, Venezuela has faced severe currency devaluation in recent years, leading to skyrocketing prices and a collapse in purchasing power. Similarly, Argentina has experienced multiple devaluations, impacting its international trade and economic stability. Understanding the risks of currency devaluation is essential for grasping the broader effects of monetary policy on global economics. Impact on savings and investments. Excessive money printing often leads to inflation, which can significantly diminish the value of savings. As prices rise, the purchasing power of saved money decreases, making it less appealing for individuals to hold on to cash. Additionally, low interest rates, a common response to increased money supply, can discourage saving altogether, as returns on savings accounts become negligible. This environment pushes many investors to seek higher returns in riskier assets, such as stocks or real estate, to combat inflationary pressures. Consequently, the behavior of both savers and investors shifts as they adapt to the changing economic landscape, highlighting the importance of understanding these dynamics for financial planning. Economic distortions and inequality. Money printing can create significant economic distortions, often leading to asset bubbles in sectors like real estate and stocks. When easy money policies flood the market, investors flock to these assets, driving prices up and creating a disconnect from their actual value. This phenomenon disproportionately benefits the wealthy who have the resources to invest, while lower-income individuals struggle to keep up. As a result, the gap between the rich and the poor widens, exacerbating inequality. For instance, during the post-2008 financial crisis, the tech sector saw massive growth fueled by low interest rates, while many working-class families faced stagnant wages and rising living costs. Understanding these dynamics is crucial for addressing economic disparities. Long-term economic stability. Excessive money printing can severely undermine long-term economic stability. While it may provide short-term relief, flooding the market with money often leads to inflation and asset bubbles, creating an unstable economic environment. This instability can increase the likelihood of future recessions, as seen in various historical contexts where easy monetary policies eventually backfired. For instance, the 2008 financial crisis was partly fueled by unsustainable lending practices and inflated asset values. To mitigate these risks, it's crucial to prioritize sustainable fiscal policies that balance growth with responsible money management. By focusing on long-term economic health rather than short-term fixes, we can foster a more resilient and stable economy for future generations. In summary, we've explored the dangers of excessive money printing and its far-reaching consequences on inflation, currency devaluation, and economic inequality. We've seen how these practices can lead to asset bubbles, diminish savings, and ultimately threaten long-term economic stability. It's essential for us to reflect on the importance of sound economic policies that prioritize sustainable growth over short-term fixes. If you found this discussion valuable, we encourage you to subscribe to our channel, like this video, and share it with others who might benefit from understanding these critical economic concepts. Your engagement helps us create more informative content that empowers viewers to navigate the complexities of our financial world.